Liquidity is back in the conversation. And whenever liquidity comes back, markets listen. Over the past cycle, we've watched the same movie again and again. Policy gets tight, risk assets fade, sentiment collapses, and then the moment the system starts to loosen, the strongest narratives come roaring back. Sometimes it's not even the headline that matters. Sometimes it's what's happening behind the headline, how money is being managed, where liquidity is being directed, and what the market believes comes next. Today, we're looking at a powerful combination: renewed policy easing signals, new Treasury bill purchases, and fresh momentum around XRP exchange-traded products. Put these ingredients together, and you don't get certainty, but you do get a setup that historically has mattered a lot for crypto. So in this brief, we're going to break down what happened, why markets reacted the way they did, and what it could mean for XRP from here. Let's get into it. The big picture: markets don't trade words, they trade liquidity. There's a phrase that keeps showing up during major macro turning points. It's not QE. Sometimes that's true in the strict academic sense. Sometimes it's a technical distinction: what assets are being purchased, what maturities, what stated purpose, what the legal framing is. Economists will argue about labels. Commentators will debate definitions. But markets are rarely emotional about definitions. Markets are emotional about liquidity. If borrowing becomes easier, if cash returns to the system, if balance sheets expand, if financial conditions loosen, risk assets tend to benefit. Not instantly, not smoothly. But as a directional force, liquidity has been one of the most consistent tailwinds for speculative assets, and crypto is often among the most reactive. So when you see policy signals shifting, rate cuts, treasury operations, central bank purchases, the important question isn't what someone calls it. The important question is what it does. What just happened? Rate cuts and a return to treasury bill. Purchases: the Fed delivered another rate cut, another step in the direction of easing. And while markets always fight over the interpretation, the pattern is familiar. Rate cuts change the cost of capital, and they shape investor psychology. But the bigger focus here is the purchasing program, specifically treasury bills. T-bills are short-term government debt, and when a central bank begins buying them, it signals that liquidity support is being prioritized. Again, whether someone insists it's not full QE is secondary. The market reads it as the system leaning toward accommodation, and it's worth remembering that these small programs can grow. Historically, policy often starts with something that sounds limited and controlled, something neat and measured. Then volatility spikes. A stress point appears. An unexpected problem hits. And suddenly, the scale of intervention expands dramatically. This is how the story tends to go. It begins as temporary, then becomes necessary, then becomes larger than expected, then becomes the new baseline. And when that shift happens, risk assets tend to reprice. Why crypto cares? Liquidity finds the fastest asset class. Crypto has a reputation: extreme volatility, aggressive rallies, brutal drawdowns. But that volatility often has a reason. Crypto is one of the most liquidity-sensitive markets on the planet. When conditions tighten, speculative demand evaporates fast. When conditions loosen, speculative demand returns fast. It's not just because traders are emotional. It's because crypto sits at the intersection of narrative and leverage. Capital moves quickly into assets that can move quickly. And this matters for XRP specifically because XRP has two major supply and demand engines that can activate at the same time. Macro tailwinds: liquidity easing, risk-on behavior, capital rotation into high beta assets. Narrative catalysts, especially around adoption, regulation, and mainstream investment products. When those engines line up, XRP doesn't need perfect news to move. It needs attention, access, and a market willing to take risk. And this is where the ETF conversation enters the room. The ETF factor: access is everything. Markets are not only driven by belief, they're driven by access. When an asset is difficult to buy, fewer people buy it. When an asset becomes easier to buy, more people can participate. That sounds obvious, but it's one of the most underrated forces in modern finance. Exchange-traded products exist to solve a specific problem. They allow people to gain exposure to an asset using a familiar format through platforms they already use, often in accounts they already have. That matters because even if millions of people have heard of XRP, many still don't own it, not because they're convinced it's bad, but because they never took the extra steps. They never made the new account. They never learned the custody process. They never wanted the friction. ETFs reduce friction. And when you reduce friction in a market with a strong narrative base, you can trigger new waves of demand that isn't necessarily driven by crypto culture, but by convenience, allocation, and structured investment flows. So when an XRP ETF goes live, it adds another brick to the bridge between crypto and traditional finance. Is one product enough to change the entire market overnight? No. But markets don't move only on single events. Markets move on sequences. An ETF momentum is a sequence. One product goes live, another issuer joins. More coverage appears. The idea becomes normal. Then capital begins to treat it as an allocation, not a gamble. That's the process. Market reaction. Why the pump didn't hold. If you watched the immediate reaction to the Fed decision, you saw something common. A quick burst of optimism, followed by a reversal. This happens all the time around major macro announcements. Here's why. The first move is emotional and mechanical. Algorithms react, traders front run, price spikes. Then the second phase begins, positioning, leverage, and liquidation. If too many traders go long too quickly, the market becomes fragile. Market makers and larger participants know exactly where the liquidity is sitting, where stop losses are placed, where leverage is vulnerable, where the easy money is. So the market often does what it does best. It punishes crowded positions. It pops, then it drops, then it shakes out leverage, then it begins building the real move. This is why daily price action can look confusing even when the larger directional forces are bullish. A bullish environment doesn't mean a straight line. It often means a violent path upward. And in crypto, that path is almost always designed to do one thing: transfer assets from impatient hands to patient hands. The macro backdrop. Why this environment feels unstable. Now, there's another layer to this, the why. Even if markets like easing, the bigger economy doesn't always benefit the same way. When rate cuts and liquidity support return, while inflation remains uncomfortable and growth looks shaky, the conversation turns toward an ugly word: stagflation. That's the environment where things don't feel healthy, but the system still has to support itself. It's the environment where policymakers are pressured from multiple directions at once. Growth concerns, market stability concerns, debt burdens, and cost of living stress. In that kind of environment, assets often become the scoreboard. People look at prices not because they're greedy, but because they're trying to protect purchasing power. They're trying to avoid being left behind by inflation or financial instability. That's why hard assets narratives grow. That's why scarcity narratives grow. That's why crypto narratives grow. When trust weakens, alternative systems become more interesting. And XRP sits in a unique position because it's not only a crypto asset narrative, it's also a payments and infrastructure narrative. That doesn't guarantee anything, but it shapes how the market talks about it during macro stress. A historical pattern, liquidity, waves create, face melting, moves. Let's zoom out. During the last major liquidity wave, assets that were suppressed for months or years suddenly ran far beyond what most people thought was realistic. That wasn't because the fundamentals changed overnight. It was because the system changed. When liquidity expands dramatically, valuation becomes flexible. Price becomes more about flow than about logic. The money has to go somewhere. And once the momentum begins, it tends to feed itself. Price rises, attention increases, new buyers arrive, price rises again. That's not a theory, it's a market behavior. So when you see early signs of liquidity support returning, it's not irrational to ask, are we approaching the beginning of another phase where risk assets reprice? Not, will it happen tomorrow? But are the ingredients returning? Rate cuts, balance sheet operations, mainstream access products. A market that still loves narratives, that's the recipe. The XRP setup, macro tailwinds plus access tailwinds plus narrative tailwinds. Here's the cleanest way to summarize the XRP setup if liquidity continues to loosen. Macro tailwind, easing conditions encourage risk-on behavior. Access tailwind, ETFs and similar products lower the barrier to entry. Narrative tailwind, XRP remains one of the most watched assets in the entire space. That doesn't mean price can't drop in the short term. Crypto can drop on good news and rally on bad news. Short-term volatility is not a signal of long-term direction. But when multiple tailwinds align, the probability of larger moves increases. And that's the real point of this brief. Not a prediction, not a promise, but a framework. The reality check. The market will still try to break you. Even in bullish environments, the market will test conviction. You can have a bullish thesis and still watch price fall. You can be right on macro and still get chopped in the middle. This is where most people lose, not because they don't understand what's happening, but because they underestimate how hostile market structure can be. Crypto markets are designed to exploit emotion. They punish impatience. They punish overconfidence. They punish leverage. They punish certainty. So when bullish catalysts appear, the smartest mindset is not everything goes up forever. The smartest mindset is volatility is the cost of admission. If the thesis is based on liquidity and access, those forces play out over time, not over hours. What to watch next? The 3 signals that matter most. If you want to follow this story without getting lost in daily noise, focus on 3 signals. 1. Liquidity confirmation. Is the system continuing to add support through purchases and easing measures? Is it growing, extending, or becoming more frequent? Markets respond to persistence. 2. ETF and ETP momentum. Are new products launching? Are more issuers stepping in? Are filings, approvals, and listings accelerating? Access expansion is a long-term driver. 3. XRP market structure. How does price behave around key levels during sell-offs? Do dips get aggressively bought? Do rallies hold more than they used to? Structure often changes before headlines do. This is the difference between reacting and tracking. Reacting is emotional. Tracking is strategic. Closing. The brief summary. So here's the simple recap. The Fed is signaling easing conditions, rate cuts, and Treasury bill purchases. Markets may argue about labels, but liquidity is liquidity. At the same time, XRP investment products are expanding and access is improving. That combination, macro support and access support, has historically been a tailwind for risk assets, especially crypto. Not always immediately, not always cleanly, but directionally. The market may shake, flush leverage, and test patience. That's normal. But if liquidity is expanding and access is expanding, XRP becomes harder for markets to ignore. Final disclaimer, plus CTA, faceless friendly. This content is for information and education only, not financial advice. Crypto is volatile, and you should do your own research and manage risk responsibly. If you want fast XRP macro and adoption updates without the noise, you're in the right place. Subscribe to XRP Daily Brief, and I'll catch you in the next update.